Well, good morning, everybody. Today is the last ISM for this semester. ISM is an investment strategy meeting, and this is for the SMILE Fund. SMILE is an acronym, Student Managed Investment Learning Experience. We have a lot of guests and folks today, so I'm going to try to give you a little bit of background information before we get the ISM going. Jacob, could you go to the next slide? Before we do that, I just want to thank everybody for coming. We have a lot of members from our foundation board, from the UC Foundation board here today. I just want to thank them for taking the time out to do this. This is very important that we thank the UC Foundation, and we appreciate their support because they are our one and only customers. So without them, the SMILE Fund would not be here. I'll get more into that in a second. We also have several members of our SMILE Fund Professional Advisory Board from several of the major employers in town, especially for investments, Unum, TVA, ACA compliance, and a lot of the investment brokerage firms in town, Patent & Patent, Patent Albertson Miller, Acumen, and so on. We have a lot of folks from the SMILE Fund Junior Advisory Board member. If you look down there, you see a picture of Robbie. And I was joking with Robbie before this all got started, but Robbie is a typical Junior Advisory Board member in that he used to be a SMILE Fund member, and now he is a SMILE Fund alumnus. And so that board is mainly young SMILE Fund alumni. Then we have a lot of UTC faculty and staff, students, and other UTC students that have joined us today. And last but definitely not least, we have a lot of new folks that are checking us out for the first time. And some of them are longtime UTC supporters, and we really appreciate that. With that being said, I just wanted to let you all know that we finally got some swag in. Ray, you've been asking about this too. So we have us a quarter zip here. If anybody's interested, you just email me your size and I will send you a complimentary one for free. We've got them all the way up to XXL. And if we need to order, anything specific, we'd be glad to help you out there as well. So with that, I'd like to go ahead and transition to the next slide. So since we have a lot of guests, let's talk real quick about what the SMILE Fund is. And I'm going to try to get to the students because really what the SMILE Fund really is, it's about the students. The SMILE Fund was started in July 1st in 2015, and the UC Foundation gave us $250,000 to manage. Since then, in 2018, they gave us another $250,000, but we've also grown those funds. In fact, the original $250,000 has more than doubled. We now have around $900,000 in assets under management. With our goal is to get that clearly up. We want to, I think right now we're trying to get it all the way up to $10 million. So we're going to throw out a number there and we're going to keep going until we get it. We started with about 15 students and we now manage a pretty large group of students, over 50 students. The vast majority of those are analysts, but we have about 7 officer positions as well. And the students get trained in a lot of different areas, but primarily it's equity valuation, investment strategies, and portfolio management. And the picture you see is our state-of-the-art Bloomberg lab. Any folks in town that have a Bloomberg terminal know that they're very expensive, and a lot of places in town have 1 or 2. We are very lucky that we have 12, which allows us to do quite a bit of training in the premier software for investment professionals. Next slide. I'd also like to point out some of our success. One of the things that the students get to do is this ISM where they get to present in front of their professional advisory board at least twice a semester, sometimes 3 times a semester. And we've also done very well against other schools. And there's other schools that do student managed funds and other investment teams. We have now won the CFA Greater Tennessee Research Challenge 5 years in a row. I'd like to point out that the industry mentor for that has in all 5 years has been Ray Ryan. So he's been a big part of what we do here in the SMILE Fund. And I think he deserves some of that recognition. We have also used some of that training that we have received from being on that team to have some of the folks on the team go on and win the Global Equity Research Report College Challenge. So this is a brand new competition. It is sponsored by some very big and important folks, including NASDAQ. And they've only done it 2 years, and UTC has taken home the trophy both years. So we have won this competition, and I think that shows you just how far we've come. We also like to take a lot of our students to New York, and we look forward to doing that next year for the GAME Forum, the Global Asset Management Education Forum. And, you know, we haven't got to do that this year, but hopefully in the future we will. Next slide. My last slide before I turn it over to the students is I just want to recognize some of our award winners. If you look at the picture down below, that is our CFA team for this year. And this year's team is pretty special. I'll go ahead and show you, if you're going from left to right, in the blue shirt there is Drew Reynolds. He's an engineer major. And next to him is Daniel Trentham. He's a finance major. Then you get Lena Chestnut. She is an entrepreneurship major with a creative writing minor. In the middle is that handsome fella right there is me, and I'm just the faculty advisor for the team. And then you've got Jacob Snook, who's also not only the captain of the team, but he is also the president of the Smile Fund right now, and you will hear from him in a minute. And then you have Reedy Bamnikar, and she is an accounting major. Now, what's really interesting about this team is not only did they win the Greater Tennessee region, the Greater Tennessee competition for the 5th year in a row, they also just won the Southeast Sub-Regional. So that, if you think about that, that is kind of like, there's a lot of big time schools, right? And so I would equate that to the Chattanooga Mocs football team going and beating every team in the SEC. And so if you think about that, it's a pretty impressive. There's 1,200 universities that participate in the CFA Research Challenge. It is the Nerd Olympics for what we do. And we have distinguished ourselves, and we are now in the top 40 in the world and the top 20 in the Americas. And that includes both undergraduate and graduate teams. And we are all undergraduate teams. So I think that that's important to point out. If you look also at the award winners, each one of these awards comes with $250 cash, which the students really do like. And so our best officer this year was Alex Varner. She really did a lot for us as VP of Marketing and Recruiting, and she brought us to engage with folks in a lot of ways online, and we really do appreciate that. Daniel Buxton has been a fantastic chief analyst for the industrial sector. You're going to get to see Annabelle and Hershey go today with their healthcare sector updates. You got to see Andrew present on NEO at the last ISM, and Denny and Chris also will get to present today, so you'll get to see them as well. And they also got analyst awards sponsored through their participation in the TVA program. If you look at our graduating seniors, we're going to lose some fantastic people. Melissa Mueller and Roman Mack are both former presidents of the Smile Fund, and Melissa's got a job waiting for her at TVA, and Roman has a job waiting for him as well over at Solomon Wood. And we also have Michael Copeland Butler, who's a former officer. Dawood Khan is a former officer. Drew Reynolds, also on the CFA team. Alex Varner, who just won the award. Andrew Molinax, who is currently over at Solomon Wood as well. And Chris Snyder, who's going to go today. So you're seeing a lot of familiar names. And I just think they will all get a Smile Fund cord. And I just think that take a moment to recognize their hard work and the fact that they've spent quite a bit of time and made a lot of contributions to the Smile Fund. We thank you and we appreciate it. So that being said, I'd like to turn it over to our president, Jacob Snook, for the last Smile Fund ISM of the semester.
Thanks, guys, and everybody just attending. It really helps us out, and we're glad to have you today. For today's meeting, the officers will be going over a performance update, a macroeconomic update from Luke, and a risk update from Logan. And we'll turn it over to our analysts for a stock pitch and energy from Chris, and then financials from Denny. And then we'll just wrap things up with the sector update and healthcare from Annabelle and Hershey. To start off, we want to go over the traditional fund's year-to-date performance as of March 31st, and we're currently underperforming the S&P 500 by about 4.88%. This is mainly due to our positions in larger technology and communication services companies, as well as a significant underweight to the energy sector. Based on our long-term horizon, which favors both tech and comms, and our relative views of companies on our approved list, we maintained our larger positions in companies like Apple and Take-Two. These were our top performers and contributors to return last year, and they led us to 12% outperformance over the course of 2020. We believe the recent pullback in many of these companies is a result of lofty valuations and relatively attractive value in reflation trades, which should see greater return potential over the coming months. We believe this is mostly transitory, and we've identified some opportunities that we'll talk about today, and we believe that could offer long-term potential as well. Here are just a look at our top 5 and bottom 5 contributors to return for the first quarter. I'll point out just a couple of highlights here. JP Morgan was our strongest contributor with an average weight of 5% and a Q1 return of 20.7%. We increased our weighting in JPM during the fourth quarter as we expected long-term interest rates to improve in the near term and for loan losses to be less than expected than businesses expected as they recovered. The 10-year Treasury yield has increased from 0.67% at the beginning of Q4 to 1.63%, which has helped banks overall, and stimulus has likely helped customers make loan payments and avoid default. Lowe's has also performed well since the start of the pandemic, and people have looked to renovate their homes and take on DIY projects while sheltering in place, so that's helped them. For our bottom 5, Roku is our largest detractor from performance after a recent pullback in our tech shares. But with our focus on long-term growth, we believe Roku is still the industry leader of streaming platforms and will see sizable growth as more people cut cable and advertisers move ad dollars to streaming platforms. JP Morgan estimates that streaming makes up almost 40% of viewing time for 18 to 34-year-olds, but only accounts for approximately 8% of TV ad budgets. Because of these trends, we still believe Roku is a good investment. Other detractors here were Take-Two and Amazon, just briefly, Apple, and they're our best performers from 2020, and we affirm our long-term view on these companies and just believe that this is a correction of a result of a larger market movement and relatively cheaper value sectors with greater short-term potential. Briefly, I just want to go over and discuss our trade request for our traditional account. In healthcare, we've exited larger pharmaceutical companies, AbbVie and Johnson & Johnson, in favor of cloud-based healthcare services company Veeva and medical equipment diagnostics provider Thermo Fisher. I'll let Annabelle and Hershey talk about that in their trade request or about our trade request in their sector update later on in our presentation. In consumer staples, we trimmed Procter & Gamble as it became almost 4% of our portfolio, diversified into snack maker Mondelez, whose portfolio includes Oreo, Trident, Wheat Thins, and Honey Maid. In consumer discretionary, we exited Lowe's, which also performed well over the past year, but will likely face lower growth over the next few years as earnings may have been pulled forward by COVID. We entered Draftkings, which saw incredible growth over 2020, and we believe still will only continue to see that growth as more states legalize online sports betting. Draftkings has an impressive 82% customer retention rate, and we believe that the recent pullback makes them an attractive investment. In financials, we trimmed JP Morgan, had a 5% holding in our portfolio, and we diversified into other areas of financials less reliant on interest income. We entered Morgan Stanley, whose wealth management business grew nearly 25% in Q4 of 2020. We believe its acquisition of E-Trade will be accretive and beneficial from the increase of participation in financial markets from retail traders. Finally, in industrials, we exited Kratos after the company drew a year-over-year return of over 100%, and shares had exceeded fair value in our opinion. We took that and also trimmed UPS in order to diversify and enter Delta, who we believe will benefit from a successful vaccine rollout and pent-up demand for leisure travel. We do think that business travel will remain subdued over the near term, but we believe Delta is better positioned than many of their peers due to its stronger balance sheet and more conservative equipment purchase agreement suppliers.
Jacob, this is Ray. I have a question.
Sure.
If you go back a slide. I'm sorry, with all the animation. All right, so you made pretty favorable comments about Roku as being a core part of your kind of long-term strategic outlook. I noticed that the average weight is less than 1%. Mm-hmm. You've had a drop in its relative value, nearly 29%. I noticed it was the largest contributor to your return in terms of losses. But my question to you is, if you like Roku, it's dropped 29%. Why aren't one of the trades that you are considering adding to the position?
So I think our position in Roku is larger than the 0.9%. We just made that trade in February, so I think average over the quarter, it came out to that. We held Splunk, Take-Two, Amazon, and Apple since the beginning of the year. And so when we pulled the quarter to date numbers, that could be affecting the average weighting there because we entered them later on in the quarter.
Okay, thanks.
Mm-hmm. I just briefly want to mention the performance in our strategic fund. The fund has performed well overall and has slightly underperformed our weighted benchmark by 1.26%. That's due to an overweight in large cap equities, and that detracted from performance. Our mid cap value and our small cap sector ETFs performed well overall. Moving on to trades, we've significantly trimmed our weighting in the SPDR S&P 500 ETF from 35% to 15%. Throughout 2020, we remained overweight as we favored the outlook for large cap domestic equities over small and international companies. Moving forward, we believe small and mid cap companies will outperform, which is typical in an expansion. And these companies will be beneficiaries of a low rate environment, recovering economy, and relatively expensive large cap alternatives. We also entered the largest Asian e-commerce company, JD.com, and 2 other REITs. Maricold owns a portfolio of 200 temperature-controlled warehouses, which are key pieces in the supply chains for grocers and perishable food distributors. And Innovative Industrial Properties owns a portfolio of cannabis cultivation and processing facilities that specialize in medical use growers. As more states legalize cannabis products for medical treatment, Innovative Industrial Properties will realize an industry-wide tailwind as it leases more production facilities. That concludes my part of the performance update. I can answer any questions before I pass it on to Luke.
Jacob, I have a quick question.
Sure.
And you may have mentioned it, may have just gone right past me, but what is the progress being made on moving entirely out of ETFs and into stocks? Is that still a goal, or is that changed?
Sure. So that still is our goal. So specifically, that was part of what we're trying to do here. We have had a lot of discussion about maybe being overweight into real estate, and so we've identified the Maricold and the Innovative Industrial Properties. Again, I think with COVID and a lot of things that had happened last year, it just makes analyzing international and smaller companies a little more difficult. And so we're taking our time. We don't want to rush going in there and just making sure that we have the due diligence. But the goal long-term would be to exit the sector ETFs and be an individual.
And then for those visitors that are new, this is our strategic fund. We have 2 funds. The traditional fund is pretty much just individual holdings. But our strategic fund, as that research develops in small cap, mid cap, and international, they will exit some of the positions that they have in broader ETFs to zero in on more specific individual holdings.
If there are no other questions, I'll pass it on to Luke.
All right, thank you, Jacob. So, hey, everybody, my name's Luke Johnson. On the screen, it says Christian. That is my first name, but I go by Luke. I'm the Vice President of Macro Analysis, and today I'm going to present a market update, which gives our macro view of the current economy. So just briefly, I'd like to go over my topics for today. I'll start out with a coronavirus update as well as a vaccine update. We'll then go over consumer confidence and spending levels, and then we'll go over our current state of unemployment and federal stimulus, and I'll end with a few notes on inflation and our current outlook. So throughout this year, the United States has witnessed a major decline in COVID cases, primarily due to the rollout of safe and effective vaccines. We do expect this trend to continue as the vaccine rate only continues to increase in the United States. Next slide, please. Thank you. The same can be said for worldwide cases up until late January of this year. Since then, we have witnessed a consistent uptick in COVID cases. So around 68.7% of these cases can be attributed to the Asia Pacific region and to Europe, who have seen increasing cases through that same period of time. We are attributing this increase in cases to mainly COVID variants, as well as inefficient rollout of vaccines and increasing daily contacts. So this table here, created by JP Morgan, shows the contribution of lockdown restrictions and variants, as well as vaccinations and acquired immunity, to the change in the reproduction number, which now is sitting at 1.061 globally. So to put this reproduction number in simple terms, below 1, new COVID cases will decline, and above 1, new COVID cases will increase. As seen in the top row of the chart, the current contribution of variants globally is surpassing the rate of acquired immunity and vaccinations, which reflects this increase in reproductive number. In order for the reproductive number to decrease past 1, daily contacts must be decreased in the face of variants. And currently at the global level, daily contacts are at too elevated of a level to create a decline in the reproduction number. A decline in daily contacts of around 1 by the global economy roughly is needed in order to push that reproduction number back below 1. We are hopeful right now that the proper steps will be taken by local governments to lower these global cases, and we'll continue to monitor this reproduction number globally, as well as new cases globally. Currently in the US, nothing is needed as far as daily contacts go to maintain a level below 1 when considering ongoing vaccinations and acquired immunity. As you can see in the chart, the downward pressure of vaccinations in the US is below the upward pressure of new variants just slightly. And we are anticipating this negative contribution of vaccinations to new cases to surpass the new variants contribution in the upcoming quarter as the acquired immunity is realized from the current cases and vaccines continue to roll out. So as you can see from these charts, the vaccine doses have far surpassed the amount of COVID cases, which is a great sign of increasing immunity across the population. But with that being said, the chart represents the vaccine doses, while the majority of COVID cases require 2 doses to be considered fully vaccinated. So in the US, approximately 19% of the population is fully vaccinated, which still far surpasses the total cases. And based upon the fact that 9 doses per 100 people have been administered to the global population, we're going to assume that roughly 4% of the population is fully vaccinated globally. So with that decrease in COVID cases in the United States has come more social spending. Open table seated diners are at near pandemic maximum levels now, where maximum level was hit in the midsummer of 2020. We are anticipating a continuation of people going out to eat, along with various other leisure activities that were eliminated by the coronavirus pandemic. Currently, the open-seated diners are at roughly 20% below what they were in the previous year, which is near pre-COVID levels, and we're anticipating that this will be nearly reached within the year. We also anticipate growth within the airline industry, which is again supported by our thesis that consumers may ramp up traveling and spending as we gradually reopen into a normal economy. Delta and Equity, we have actually just purchased, announced recently that they're opening up the middle seat on their flights. This is giving us the signal that the airlines are loosening up their restrictions and expecting demand that must be supplied. There's also room to grow in this sector heading into the summer months, where in 2019, maximum traveler throughput was experienced, which was above the 2.5 million mark. So with all of that being said, there's still evidence of caution that can be seen throughout the consumer confidence level and the personal savings rate. The consumer confidence level currently sits at 109, which is the highest we have seen during the pandemic, although the previous levels of confidence throughout 2019 hovered around the 130 level. The personal savings rate currently sits at 13.7%, which is roughly the lowest seen in the pandemic, although just like with consumer confidence, the savings rate pre-pandemic sat anywhere between 7 and 9%. So people are being cautious with their money currently, which has its pros and cons. Obviously, the con is that is money that we're not seeing right now being spent, which is the #1 driver of GDP and economic growth. Although we believe that the pro outweighs the con in this situation, because that's ammunition that the consumer can use post-pandemic when the federal government is possibly not applying their stimulus. So this could create natural growth that could gradually allow the natural economy to go from crawling to running on its own. U.S. retail sales mainly saw a dip in the midst of the early pandemic and have benefited from government stimulus and recovery. Consumer spending has experienced mainly growth from month to month throughout the pandemic due to fiscal response and recovery, and has become less volatile throughout the pandemic. We are also seeing an increase in spending as more businesses reopen and as consumers feel more comfortable spending throughout the upcoming year. So looking at the unemployment rate currently, we're sitting at 6%. Which is a decrease from the previously reported level of 6.3% last month. This is resulting from the 916,000 jobs that were added in March. We believe this decrease will continue as consumers are spending more and pent-up demand needs to be satisfied by suppliers, and that requires workers. Initial jobless claims have also gradually decreased after reaching a peak in April of 2020 when the pandemic first struck. So looking at the federal funds effective rate, it's still sitting at near zero levels. Jerome Powell, chairman of the Fed, has publicly stated that they do not plan to withdraw any policy support in the foreseeable future. This monetary support by the Fed includes $120 billion per month in bond purchases, and any indicator of change in this policy would be full employment and a sustained inflation rate of 2%. The Fed has stated that they would like to meet these two goals before pulling back economic support. We're not anticipating any change in monetary support in the near future, but we'll continue to monitor the unemployment levels and sustained inflation levels that may indicate change in this support. So with the Federal Reserve's continued stimulus and as anticipated demand ramps up with limited supply, a temporary spike in inflation is expected. So as the market realizes the updated state of supply and demand, we're expecting volatility while a gradual equilibrium is found within each sector. As you can see, the 5-year TIPS break-even rate currently stands at 2.43%, which reflects our view of a temporary inflationary period when compared to recent levels. So an inflationary period to us is not meant to be taken in a negative context, but it's meant to address the occurrence of that period, which we are expecting in order for the Fed to meet their long-term target rate of 2% inflation. As you can see from 2011 to 2014, the TIPS break-even rate stood roughly above the current point, although the difference between then and now is that the jump in inflation is following a deflationary period caused by the extreme drop in demand from COVID. So we're placing an importance on this current 2.43 level because we are anticipating it rising higher, at least temporarily. We also plan to closely watch the rates as the Fed plans on basing their policy off of the long-term inflation rates, which could be affected if our assumption is correct that demand will pick up as we near the end of the pandemic and suppliers increase prices with that demand. The current U.S. inflation rate stands at 1.7%, which still stands below the Federal Reserve target rate of 2%. We foresee that inflation rate increasing to and possibly even slightly above that 2% benchmark set by the Federal Reserve, especially if unemployment levels do not drop at a higher rate than they currently are right now. So with that being said, we will continue to monitor these rates and any statements that the Fed may release, which indicate policy change that would affect the economy. The Treasury yield rates show the rapid increase in yields, which also reflects our view of economic growth. As the market anticipates rising inflation, obviously there will be an increase in Treasury yields, and the expected economic growth can cause a rise in yields due to the shift from Treasuries to equities during a time of growth. To us, this is just another indicator of expected growth by the market. So another form of stimulus is the Biden administration's infrastructure plan, which includes trillions of dollars of spending to increase the United States infrastructure. As seen in the chart on the right, transportation will be the primary recipient of the spending, while other sectors such as electric vehicles, home and community care, and manufacturing will also receive a chunk of stimulus from this fiscal policy. We have not currently made any purchases due to this infrastructure plan, yet we are looking to locate the primary beneficiaries of this plan, and we are hopeful about the jobs and stimulus that this new plan will provide to the overall economy. So just to sum everything up, we're viewing the next quarter and the rest of the year to include a continued vaccine rollout that leads to a decrease in coronavirus cases. This is especially true in the US as some countries are struggling more with vaccine rollout and maintaining the correct social guidelines. We're hopeful that local governments will adjust appropriately and change policies to adjust daily contacts so that the reproduction number can arrive at appropriate levels. We believe that this decrease in COVID cases will lead the consumer to release pent-up savings from stimulus and from precautionary savings during the pandemic. And we anticipate a continued decrease in unemployment rate as well that should lead to more household income and spending. So mainly based upon this unemployment rate, the Federal Reserve should continue to administer stimulus through the near term. While inflation is expected to run at a higher rate in the near future, we do expect the Fed to tolerate these rates, especially until their goal of full employment is met. Finally, fiscal policy will cause even more of an increase in jobs while also giving more cash to consumers. So therefore, we're seeing that return to normal stocks will benefit in the near future as we are shifting to a more normal market and economy, as well as companies that will benefit from ongoing healthcare trends from COVID. Although we do plan on maintaining our long-term views on some of our technology holdings that have suffered recently due to the rising interest rates. A few examples of our recent purchases that we think will benefit from current market shifts are Delta, Draftkings, Mondelez, and Thermo Fisher. As you'll see in Logan's presentation, we are currently underweight in discretionary, and we're viewing this as a huge opportunity to make change in our portfolio before the end of the semester. And finally, you're going to hear a presentation on Intersys today, who could potentially benefit from the proposed infrastructure plan through electric vehicles. So thank you all for listening. I'll now open it up for discussion and then hand it over to Logan.
I have a question, Luke. So this is Leonore Brown, Assistant Professor Economics. So I know you said you bought Delta because of the prospect of flying, but then with the new variants on the horizon, what do you think about that? And do you think that prospect will be realized anytime soon? And also with the fact that they're saying the vaccine only lasts 6 months in your body, I think I heard something like that. Do you think that prospect that you're talking about, you think it would be realized in the short term soon, or you think it will be more of a longer term?
Right. Yes, ma'am. So we are viewing that definitely in the short term, as more people are getting vaccinated, that we will see more people flying. And also Logan in his risk update is going to talk a little bit more about the variants more in detail. And we are definitely keeping an eye on those variants very, very closely. But as far as this quarter goes, we do expect more people to fly. But yes, that's a great point, that the variants are posing a bit of an issue. But like I said, in the near term, we are expecting more flights.
And I have one last question. Sorry to take up your time.
Oh, you're just
So with inflation going up slightly, right? And I mean, based on what I've heard, it's based on the stimulus and all of that. So do you think that's just a temporary rise, but then it will eventually go back down, and then the Fed don't necessarily need to do anything about it? Or do you think it will continue that way, especially now that the new stimulus with the infrastructure is being ruled out, if it gets passed?
right. So we are expecting demand and spending to be coming along with this stimulus. So yes, we are viewing more of a temporary spike than a long-term rise in the 2% benchmark. So long-term, we are still believing in that 2% outlook in inflation rate. But yes, definitely more towards the near term, we are viewing that as more of a temporary spike, as more of an equilibrium is met with the rise in demand and supply is met. As we're going through this quarter and the end of the year, returning more to normal.
Okay, thank you.
Yes, ma'am.
Hey, Luke, I had a question.
Mhm.
So, as you may be aware, we've seen a rise in bond yields as these inflation expectations have picked up. The 10-year has risen. My question is, have you guys considered at what point? So we're currently trying to fund all this stimulus with debt, and because we've had such low rates, it's been relatively easy to issue more debt. Low rates, not a big deal. At what point does the rise in rates get to a point where we really can't afford to keep issuing that debt? And how would that lack of additional stimulus maybe impact markets? Have you looked at that at all?
We have looked a little bit at the increase in yields, like I showed, and like you said, it's gone up fairly quickly. But we also do think that this is going to be absorbed as it goes on. And I can't give you a specific number to where if those yields did reach that rate, that we would see the Fed kind of pulling back. Right now, our view is that they're going to continue with this stimulus, as they need.
So it's not the Fed I'm asking. I'm more asking about the fiscal side. If we keep issuing bonds, is there a point where it becomes too costly to issue the bonds? You sort of like rolling over that debt to a higher rate. If you understand that, maybe.
So I right now we are viewing these rates as something that will be absorbed. And so I don't know if there's exactly a point to where we would view that being. Right now we are viewing it as stimulus that is going to be applied, and fiscal things that will be applied to where we get through this pandemic. So I'm not exactly clear on what you're asking, but
I think what is just the cost of the federal government sort of issuing debt, and that I think it's a good question, but I think you have more of a push even towards things like modern monetary theory. And there's a lot of things that, even at the federal level, people talk about. It is even rising federal debt an issue. And so I think when you're talking about fiscal stimulus, there's, less of a concern about paying it back almost than, the Fed was more policy focused. I think the fiscal stimulus is more focused on just getting out of the pandemic at this point. So I'm not I'm not sure what that discussion looks like. I think that we as a fund probably need to get together and just have a discussion about that, and if there is limitations to how much stimulus would be provided. But I think that's a good point.
Hey, Luke and Jacob, clearly you all are keeping your eye on the inflation number, and rightly so. Would you explain how that plays into your allocation decisions?
Sure. So I think with our recent trade request, you saw that we had trimmed a little bit in JP Morgan and went into Morgan Stanley. And I think that from a financials perspective, even we're focusing more on financial sectors or industries that aren't as reliant on that net interest income, who aren't going to face as much pressure with the inflation. Morgan Stanley has an asset management business and a trading business, so that we've diversified there. And I think there's also implications for things like real estate. And so we've had those discussions about going overweight in real estate or allocating more money to real estate in the strategic fund. And you saw that with our REITs. So
is that because you view it as a hedge against inflation? Is that your thought there?
Well, it certainly is, but I think long term, I think the REITs decision, or real estate overall, would benefit from that. But with the REITs decision too, there is an attractive growth story specifically for the companies. But those are some of the discussions that we've had with financials of diversifying, and then also with the real estate as a hedge would be a good investment.
Do you all have a view on cryptos?
So it's something I've done a little bit of research on, not enough to sort of say whether or not we have investments in specific companies lined up. But we have looked at news with China talking about issuing their own cryptocurrency. So I think it is becoming more and more of an impending issue, just as governments start to get involved with this as well.
Okay.
I want to just throw out, if the small fund heads in that direction, you have to change the investment policy. These funds can only own equities. So I know that there's in the works possible SEC approved ETFs that would own crypto and digital assets, but I don't think those would qualify with the way the investment policy is currently constructed. Would like to throw out a couple of suggestions. Luke, if you go back to that table with a lot of numbers that you said came from JP Morgan, I think one of the key aspects of your presentation, maybe you missed on, whoever's got control of the slides, if they can go back to that.
Back on them, please. Yeah. So. And it's that.
Right. Yeah. So I think the key here to studying this is there's only one country that has theoretically achieved herd immunity at this point, and that's Israel. And so what you want to see is that number in those columns not only get smaller, but become negative. And so we are approaching herd immunity, but we're not there yet. And the way to look at it crosswise is to see, according to their calculations, the contribution of vaccines is a very beneficial aspect to what we're doing, but the number of new variants or the new cases associated with new variants is still larger than the decline associated with vaccines. But this data is only through the middle of March, and so as it's updated, you'll likely see the vaccinations overcome growth from new variants. So I think Jake, or excuse me, Luke, the one thing perhaps if you were to redo your comments as a suggestion, I think the key phrase you missed from this discussion was the concept of herd immunity. And for all the students involved with this, understand that the growth in the cases, it's nonlinear, and so as it goes the other direction, meaning we get below a reproductive rate of 1, it will also be nonlinear. So it'll be evident when we hit herd immunity where new cases absolutely collapse, which is what's happened in Israel. So I think the key thrust of the presentation, if I understand it, is that you're positive on the balance of the economy because we're making progress against the virus. But perhaps as a headwind potentially are the concerns related to inflation. Luke, is that fair?
So you're saying that what we were focusing on more was the inflation rather than the collapse of COVID cases as vaccination?
No, I'm saying that you did a lot of work on the vaccine and the number of cases, but I think the key phrase you missed in this is the concept of herd immunity, and that's clearly what the entire world is hoping to see in the next month or so. And once we get to the other side of herd immunity, you could expect to see even a greater acceleration in economic reopening. So it's a nonlinear impact is my point, but you also, half of your presentation was about inflation. So you're suggesting that that's a headwind with the possible threat of a change in monetary policy. Okay, and that would be if inflation exceeds their targets by a substantial margin. Is that a fair way to say what your outlook is?
Yes, very, very fair. Yes.
Okay, so if we go forward now to the slide where you have at the top and the bottom, the break-even rates and okay, one more, I think. Nope. Keep going. Yeah, right here. So you've got the actual inflation rate, which presumably, and I'm going to make a suggestion to you the next time you do this. Tell us what this is. I presume it's CPI, and I presume it's headline CPI, but the government also produces CPI core. So tell us what this is, okay, as opposed to the quote US inflation rate, because that really doesn't exist. The Fed prefers the PCE, which is the personal consumption expenditures. I mean, so help us understand what we're looking at here. I'd like for you, though, to interpret for me the top. So you're talking about the TIPS break even, and you're assigning a lot of value to this indicator. Tell me what the TIPS break even means.
So that to us, that is just the expected inflation over the next 5 years. So to us, that means that people are expecting this inflation with pent up demand that will be released and with stimulus. So like you said, right now we see that, meaning that people are expecting inflation that will be absorbed by the Fed, meaning that their stimulus will continue throughout this year.
Okay, my suggestion then would be that's close. The TIPS break even is the difference between nominal treasuries and TIPS yields. So you take the difference out, and that's what the market implied real rate of return is on treasuries. So this is the market's expectation for where inflation will be 5 years from now. Okay.
Right.
That's what the 5-year TIPS break even means. It's saying the market believes that inflation 5 years from now will be about 2.5%. That's what's priced in. Okay. So I just want to make sure when you do this as an update, you understand what you're using as comparisons, and it's not really an apples to apples, I guess is the point I'm making. Okay, Luke?
Yes, sir. Yes, sir.
All right, thank you. Those are fantastic comments. What we're going to do now is transition to Logan. If you have some more comments for Luke, you can put them in the chat box, and Luke or Jacob will try to chime in and answer those for you. And Logan is going to discuss a little bit about the variance as well, so it can kind of continue the discussion.
All right, hi, my name is Logan Painter. I'm the VP of Risk Management and also Chief Analyst of Healthcare, and today I'm going to be giving you all a risk management update. So first, we're going to look at the performance metrics of our traditional fund. What I want to talk about here is in 2020, the Smile Fund outperformed the S&P 500 enough to where our trainer ratio showed that our portfolio was a more suitable investment. And as of now, our trainer ratio is underperforming the S&P 500. We will look at the specific parts of our portfolio that are causing this low number in the next slide about attribution. So we have underperformed in energy, and allocation is a slight weakness for us overall. Part of what happened in energy is us exiting our oil positions and switching to more of a renewable energy outlook for the long term. For that, we have a energy stock pitch later in this presentation for you all. But as of now, let's look at the selection effect. So I first want to address that historically in the fund, we do a good job at selection. What we like for the long term is not performing the best here, and you can see it in our selection percentages. However, we are still confident in our long-term investment horizon for these picks and that they will hit our adjusted target prices. What we do not like is the underweight in discretionary, and we're working it out for the next trade. We will adjust before the summer for this trade request, so it will go in before we stop for the summer. And industrials might have some type of effect on this as well. We're going to look into it. For right now, what we really like is healthcare going forward, and we have denoted a whole sector update talking about this. Okay, COVID-19 variants. Let's get into this. There's a new classification system that I want everybody to become aware of because it is most likely going to be seen in the news and going to be talked about more. What I want to put out there immediately before I get into anything else, though, is that my position in VP of Risk Management is going to have me playing more of a devil's advocate in this. So take that into account and have everything with a grain of salt. So what are these variants? Variants of interest. These are variants with an evidence that demonstrates it is the cause of increased number of cases. But these are also limited cases or limited expansion in the US or other countries. These are usually the ones that don't have as high of a transmission rate and are just somewhat mutations of the normal virus. Variant of concern, though, is a little bit different. Variant of concern has evidence of impact on diagnostic treatments and vaccines, as well as evidence of increased transmittability and evidence of increased disease severity. What you do not see in this slide is the final classification system, is the highest one called variant of high consequence. And what that does is these variants would have to have evidence of or be voted by the World Health Organization of a significant reduction in the vaccine effectiveness, a disproportionately high number of vaccine breakthrough cases, or very low vaccine-induced protection against severe disease. And they would also have more severe clinical disease and increased hospitalizations. As of now, there is no variants that fit into this category. And for us to have one in that category, who would have to do a big meeting, and it would be a whole long process before we see anything go into that category. I'm going to go into some of these variants a bit. So we see in my variants of concern, both the California variants actually have a 20% more transmission rate than the original strand and have what specialists call a significant impact on the ability of treatments authorized by the FDA, which also includes a moderate reduction in vaccine performance. Also in variants of concern, we see the UK and Brazil variants actually have a 50% increase in transmission rates and a larger amount of people being hospitalized. We're going to look at some of the risk factors of these variants now. These are some potential variant risk factors. I'm going to put that word out there big, potential. So in this, nothing is concrete and more research will have to be done before any claims of efficacy on the vaccine are proven true. But we'll talk about this right now. What would happen if a variant of high consequence were to appear, or the variants of concern were to go rapidly in the coming months? Well, here's some cases on what could happen. If over 50% of all COVID cases in the US become variant dominant cases, then the CDC and the government are likely to consider the current vaccines that we are using to become outdated, and new vaccines for variants could be something that has to happen. As of right now, Moderna has actually started a clinical trial, will be starting a clinical trial after the end of April on B1.1.7, which is the UK variant. They're filling out the clinical trials with people from the last vaccine trials, trying to get people who have already had the vaccines in there, saying it could be after you have the first vaccine, you would have to take these so they could be quicker to be approved. But we will not see any evidence on that until months down the line this year. So we are also currently vaccinating at a rapid pace to get closer to herd immunity later this year. But if these variants spread, will herd immunity even matter? For this, we will have to see what the future holds. It is not something you can easily test in clinical trials, and more so something you have to see with real data in the world. And that would happen much later in this year. Finally, as all these things happen, the worst case scenario for this year would be that 2021 becomes worse than 2020. Because of this, it will be imperative that we have to at least investigate the new data coming out of these variants every week, if not so every other day. And I think you are also inclined to do so. And the biggest point in this is that we need to stick to the data and play safe. I'm open to all questions now.
Logan, this is Ray. Thank you for all that. A lot of work on the virus and vaccines during this. But I think it's important to put this into the context of the portfolio. I mean, both of these funds are supposed to be invested at all times in equities. These are long equity. If you don't like the stock market, you can't just raise a ton of cash or start buying bonds. That's not what's permitted in the investment policy. So from the standpoint of risk management, and again, the evaluation of Smile Fund is always going to be relative. It's going to be relative to an index. So from a risk management standpoint, we should be having a conversation with more greater depth about what you think the appropriate betas should be, right? What I find interesting, if we go back, is that you all have made some changes to the account to get it more exposed to, say, the reopening theme, but the beta hasn't changed. And so I think the parameters which I generally ask for when we get to the risk management of these ISMs is let us understand, like you presented a possible real bear case without acknowledging the fact that last year most of the economy was shut down and this fund performed quite well because it had a huge allocation to tech and those tech companies benefited from things being shut down. So do you anticipate recommending to your fellow officers that you pursue a rotation back into tech aggressively if you see these variants accelerate? I mean, put it into a portfolio context, Logan. So I think the information about the variant's helpful, but we need to understand what you all plan to do in terms of the actual buys and sells in the portfolio.
Okay, Jacob, can you go back to the beta slide? It would be the first slide for me. I would like to touch on the beta for this. So the beta in 2020 is very hard. It's the exact same as right now, but that is pushed up from some of our positions in non-classified cash, which would give us a very low beta as a 0.44 from what we were reading. So that definitely lowered the beta for 2020, when in actuality, it would be much closer to 1 if we got rid of that. But as of right now, we did not include the beta from non-classified since we barely have any weight in it. And this beta is more so looking what all the other sectors are, whereas 2020 is influenced by the non-classified cash that we still have.
Sure, and I would also say, Ray, I think that the conversations we've been having with the Outlook is that if, based on these COVID variants, if we think this could become a material issue, then we need to have conversations about beta and the tech allocation. But generally, I think the outlook now is that the vaccine rollout is going really well. There has been success in reducing COVID cases. And so, we have a lower than 1 beta. And I think, over the next couple of, or the next trade request, especially when we're moving more into discretionary kind of sector, we would want to see that beta come closer or maybe above 1. And so I think hopefully that will be addressed in the next trade request and be discussed a little better there.
And I'll also just say something real quick because I know this is taking up a while. Like we've said, we're still very long-term on our tech holdings that we have right now, despite the fact that we also believe these cases are going down. So we think that it's not necessarily due to a COVID trend. So if we were to shift back into a shutdown, we believe these holdings will benefit our tech holdings. Also, like obviously Delta we would have to take a new look at that buy and do something about that. But we are set up kind of in a way to where we could shift quickly because we still do believe in our long-term outlook with those tech holdings.
Now, to finish that question out, you said, what would be my advice from BP? So mine for the next trade request is I would like to look at stay-at-home stocks, nothing brick and mortar, and look into maybe seeing if the market might have already priced in something like this happening since fear has been selling so much recently.
Okay, that's a good answer. Thanks.
All right. So what we'll do now is transition over to our analyst. If you've got any more questions for Logan, please put them into the chat box. And so it might take us a second to answer some of those because some of those answers probably should come from Jacob, who's also working the slides. But we'll do our best to get you the answers to those at some point during this presentation. With that being said, Chris, why don't you go ahead and tell us about Intersys?
So hello, everyone. My name is Christian Snyder, and I'm the lead analyst for the energy sector. The company that I have evaluated is Intersys. Intersys is currently trading at $93.76 as of April 1st, 2021. The market cap is $3.5 billion. Through my DCF valuation, I've developed a buy recommendation with a target price of $115.01, which would be around a 22% return. Intersys is the market leader in industrial stored energy solutions with a 32% global market share. They have the capabilities to leverage their technology with future innovation. There is also a clear path for growth in each of their sectors, and Intersys will be able to capitalize on the move to ESG investing. Intersys breaks its business down into three sectors. Motive Power is the original equipment manufacturer for the industrial sector. They create batteries for heavy machinery, such as forklifts, railways, and mining applications. Energy Systems is in line with telecom and broadband, as well as stored energy and for common and emergency use. Most of the growth would come from the 5G sector and increased needs for stored energy. Specialty is the battery creation for transportation, aerospace and defense, and other small applications. Even though this is the smallest sector for Intersys, they are moving towards growth in this space. Core growth is going to occur in their business through lead acid battery demand. The U.S. Department of Energy expects global lead acid battery demand to increase 5% annually until 2030. Even though this usage may not translate directly into sales, because Intersys creates lead acid batteries for their sectors, it will impact Intersys. This could also lead to continued innovation of the lead acid battery, which has a 99% recyclability rate. The energy systems growth will come from the shift from 4G to 5G. This will be captured through small cell powering for towers. From the chart, you can see that North America 5G spending will approach $6 billion into 2024, as 4G spending will decrease over this time. This is where one in the hand is better than two in the bush, as this growth is most likely going to happen. On the flip side, there is a possibility for massive growth in the specialty sector. This can be seen through the Northstar acquisition, which makes batteries for vehicles. They would like to capture a higher market share in the transportation space from where they are today. Even though the 20% and 2% market share numbers are aggressive, this could be reached as they are an environmentally friendly company with 99% lead acid battery recyclability. There's also motive and energy growth possibilities with the world's electrification. They will be able to leverage their technology with renewable power storage and battery possibilities for future applications. Most of their business is centered around North and South America. They do have exposure to Europe, Middle East, Africa, and Asia. As you can see, there's consistent growth in net sales, and I see this trend continuing in the near term. Some of the risk involved with Intersys is maintaining market share, as they do compete with new and old companies alike, making their market share more difficult to keep. The innovation through acquisition could be a problem at times if the whole business does not fit within Intersys. The largest competition that I have found is Clarios, East Penn, and Exide. The most comparable companies are the best publicly traded companies consisting of Energizer, Bloom Energy, and Hubble. EnerSys has posted consistent gross profit of 25% through COVID-19. COVID-19 will affect the fiscal year 2021 10K due to the company's reporting dates. The earnings per share also recovered well from 2021 lows, as you can see from the earnings beats highlighted in green in fiscal year 2021. Through running historical and relative DuPont evaluations, I found that the operating margins have been consistent throughout the years, with the only decrease coming from acquiring Northstar in fiscal year 2020. Their debt to equity was also better than other battery and energy solution companies. This could show an opportunity to leverage debt for the future. For my DCF model, I have used the probabilities of a bear case of 25%, a base case of 60%, and a bull case of 15%, with the interim period growth rates of 2%, 6%, and 9% respectively. I have used can you click one more time, please? I have used a beta of 1.37, a risk-free rate of 1.74%, and an expected return of 9.5%, giving a cost of equity of 12.39%. With the cost of equity being calculated as 12.39% and a 3.01% cost of debt, I calculated the WACC of 7.84%. And the blended target valuation for the probability of each section happening is about $115 with an upside of about 22%. To conclude, EnerSys is a business that is across multiple sectors. It is in line with ESG investing as they can recycle 99% of their materials. There are growth opportunities now and in the longer term that can benefit from the new administration through infrastructure bills. Cons are simply the lack of publicly traded companies to compare. I do, however, think that the pros significantly outweigh the cons of this company, showing an opportunity in the energy sector. Thank you, and I am open to any questions.
Christian, I thought that was good. I thought you did a nice job. How many years are in the interim period of your DCF?
5 years.
And then is that a free cash flow estimate?
Yeah, so I did do a free cash flow model for my DCF.
Okay, and how did you calculate free cash flow, and where did you get the information for the CapEx requirements of the business?
So I got the CapEx requirements from the assumptions with the 10-year Treasury yield from the April 1st data that I pulled, and then the 2%, 6%, and 8% for the assumptions. So EnerSys is expecting the energy systems and motive power to expand at 6% into 2025, and they're expecting a 13% increase in their specialty sector into 2025 as well. So I've kind of figured that a 6% would be a little bit better. And then past that, also with the expected consumption of the lead acid battery of 5%, I kind of thought that it was a pretty good indication of where the lead acid battery space is going, posted by the United States Department of Energy. So.
Okay, very good.
All right, thank you. If we don't have any other questions, or if you have some thoughts for Christian, please post them in the chat box. And just for the sake of time, we'll go ahead and move on to our next presenter.
Hello, my name is Danny Pond, and I'm the Chief Financials Analyst. And today I'll be presenting Silicon Valley Financial Group. The ticker is SIVB. You may go to the next slide, please. So my investment thesis goes as follows. We would like to take a position in the innovation economy, and with an underweighted financial sector, I would like to take advantage of SVB's future increase in net interest income, its great position to benefit from an interest hike, having the best deposits and loan growth amongst its comps, and its PVC, private equity venture capital arm that lowers overall credit risk. You may go to the next one. Here are some of SVB's financial group's key informations. I'll be conducting a sum of parts valuation with a price to book multiples approach. And with my valuation, I expect a 5% upside from the current price of $484.59 to $509.51. Okay, and let's explore the SVB Financial Group's revenue mix. You can understand the slide as SVB's industry revenue mix versus its internal revenue mix. So since Q4 of 2020, SVB has an increased weighting in private equity venture capital from 15% to about 24% we see nowadays. Its commercial banking weighting has decreased from 85% to 76%. And real quick, SVB's revenues mostly comes from commercial loans, as shown as SVB's global commercial banking on the right side. And Leerink and Capital are its PVC arms in investment banking and venture capital that focuses primarily in the life science, biotech, and healthcare industries, while SVB Private Bank focuses in wealth management and advisory services. Okay, the NIM and the NII here I pulled from the actual financial statement from SVB. These are the net interest margin and net interest income. This is basically the profitability measure that it's influenced by the FOMC set interest rate. The NIM is correlated with the Fed funds rate, and by increasing it, banks can charge a higher loan rate. And worth mentioning is the fact that the Fed does not expect to increase the interest rate until 2023 and would like it to remain at the current levels until certain levels of inflation is reached. The FOMC has basically said that the current profit margin of banks has bottomed in that way. The Biden administration also openly expressed letting the FOMC decide on interest rates matters rather than forcing them to keep it low. We expect the net interest income to improve still. Right, and in the last 35 years that SVB has been founded in 1983, it's extended its geographic arm all over the world. Go ahead. And some of the more well-known clients of SVB include Datadog, a company in the data solutions industry, comparably a platform similar to Indeed and Glassdoor, Pemetrix, a company focused on improving various HR functions with technology, and Airslate, a company that currently pioneers a no-code business automation platform. Go ahead. And one of the most important factors when considering investing in the present is the ESG disclosure scores of companies. And we know that SRI is becoming much more important with millennials soon to dominate the market. SVB's social disclosure score has been gradually increasing in the last 5 years, and its corporate governance disclosure score will ensure its transparency with investors has remained dominant even among its comps. And as you can see, SVB here is denoted in the solid white line. It has consistently increased both its loan growths and deposit growths as compared to its comps. And in fact, taking the title of highest loan growth and deposit growth in Q4 2020, this points to SVB's ability to cross-sell its financial products. And moving forward, keep in mind the substantial increase in loans. And one of the major contributors to loan growth is something called capital call lines that SVB utilizes. And you can understand this as a kind of like a credit card given to PVVC firms is now more than 50% of the loan growths. SVB leads its commercial banking peers in terms of short-term liquidity. I have here plotted with these charts here. I have the interest income to interest expense ratio that I've computed for SVB and its peers represent the last 4 years here. And it has consistently boasted highest liquidity levels. This is especially important as a short-term stress test. It's proven itself to be able to push through crisis. And with the highest one at Q4 at 18.12. Go ahead, next slide, please. And on this slide, we see that this represents the SVB's liquidity tier 1 capital. This represents one of the most important banking metrics. The tier 1 capital ratio includes the bank's equity capital and disclosed reserves compared to its total risk-adjusted, risk-weighted assets. SVB's tier 1 capital ratio seems to be relatively stable, even considering the fact that their total deposits grew by 65% in Q4 of 2020. One of my main investment theses was to take advantage of SVB's great position to benefit from an interest rate hike. And with the majority at an astounding 91.52% of SVB's total loans being variable rate loans, SVB is expected to reap in benefits as the Fed fund rate increases. And this is due because contrast to fixed rate loans, variable rate loans, interest rate is charged on an outstanding balance and varies as market interest rates change. And a great number of SVB's variable rate loans mature in more than a year, which is around 2023 or later, and these represent about roughly 21% of them, and these are expected to benefit from future interest rate hikes. Continue on, the SVB's non-performing loans to total loans have been steadily dropping as SVB's investment banking arm, Leerink, strengthened over the years. Through a stronger exit market, SVB is able to keep defaults lower by exiting out companies through its PVC services. SVB has put in substantial effort in lowering the overall non-performing loans to total loans. It is among one of the strongest in this area. Moving forward, we must keep in mind the integration risk from acquiring Boston Private and making sure that certain levels of corporate memory must be retained. Compliance and capital adequacy under the Basel III Tier 1 capital of 10.5% should be kept, and the current Tier 1 ratio of SVB hovers around 11%. This is also a form of stress test, and if SVB is compliant up until June 30th, the Federal Reserve has released a statement allowing regional banks to buy back their shares. And SVB's revenue mix has an inherent credit risk from its loans to high-risk startup companies and tech, life sciences, healthcare. And high demands of IPO could cannibalize sales and cannibalize revenues in the loaning arm of SVB, but increase revenue generating powers of Leerink and SVB capital, while low demand would cut into underwriting and advisory services of SVB. And lastly, a further decrease in the Fed fund rates will impact SVB's NIM, which will decrease SVB's net interest income. So starting on this slide, I've based my valuation on using the price to book multiple. To compare apples to apples, I've listed some of the largest banks under the KBW Bank Index, which SVB is also part of. And as shown, the average price to book is about 1.8 times the book value per share. And in order to be as accurate as possible, I've decided to factor in the average US private equity price to book, since roughly 24% of SVB is in private equity and venture capital. As shown, the average price to book here is about 8.6 times the book value per share, and I'll now continue to perform a sum of parts valuation. To perform a sum of parts valuation, I multiply the book value per share with the average price to book of the large cap banks, multiplied by the weighting of commercial banking SVB. I then took the book value per share and multiplied it by the average price to book of US private equity and multiplied that by the weighting of private equity in the SVB. I added two products together to obtain my valuation of $509.51. And this represents a price upside of about 5.14%. And as well, I have listed here the average analyst consensus about the last 2 weeks. Next slide, please. And at this time, since the upside is less than 10%, I value this company as a soft buy. However, I believe there is more value to come for this company, as mentioned earlier, due to its extraordinary growth last year, as well as unique positions to benefit from a recovering economy, which bodes well with PBVC and banking. PVCs are expected to do well in an environment post-COVID, and the pandemic has taught PVC investors how to invest and do due diligence remotely and more efficiently. And a healthy economy in the future will mean healthy exit markets, which equals healthy PVC investments, and that turns into higher loan demand and cross-selling into private banks, loans, and wealth management. Yeah, go ahead.
No, you're good.
Yeah, I'm good. Next slide, please.
I think that's her.
Oh, okay. Oh, so thank you all for your time. I'm now open for questions.
And Denny, I'll make a comment. First, analyzing a bank is probably the most difficult type of company to analyze. And you impressed me with your command of the various factors that you need to examine to determine the proper valuation for a bank. So I'm impressed by the depth of what you delivered today. I would recommend to you, though, maybe you try to deliver 50 pounds of information in a 10-pound bag, just because you spoke so fast. It was very difficult to follow. So I think streamlining your thoughts might be a bit more effective for the next time. But I want to say, though, that your work is impressive. I think just generally, though, Hunter, I mean, we have struggled with this with each ISM team is, we should have some parameters as to what something is a buy or a sell, and I think we should have some consistency, because you introduced a new one, Danny. I've been on the Smile team since inception. And so this is the first time I've heard of something called a soft buy. And I don't know what to do with that, right? So I don't know if that means you buy it, but you control the size of the position, or you're like, I buy it, but I'm not really enthused. So I think, having some consistency is going to be helpful for us to understand what you're actually recommending. Okay.
So if I may, it's mostly a soft buy because of interest rates aren't expected to hike in the near future. So it's out in, like, say, 2 years time. So from 2023 onwards, that's whenever you would reap the benefits there, I expect.
But you make an excellent point, Ray. We do need to come up with some kind of consistent language around what constitutes a buy and a sell for the fund. I do think that each new group might not have heard us have that discussion. So we probably need to get that down in writing and somehow let everybody understand what our parameters are.
So here I'd like to also just give credit to Steven Zerlo and also Chandler Derman here. They both helped me out a lot here. So of course, 100% credit does not go to me.
But I will say that Denny did a good job of reaching out for help, and he knew that banks were difficult, but he has done quite a bit of the learning, and I too have been impressed with his valuation in particular. I think that Ray's point is well said, that it'd be nice to have been able to follow something that complicated in a little bit easier manner. It was a tough task for Denny to pull that off, but you did a lot of hard work, Denny.
Yes, sir. Thank you, sir.
Hey,
Denny,
Denny,
this is
I will echo that comment as well. I think that was very impressive. And we'll give soft credit to Stephen and Chandler, if that's the new thing we're going to be using.
Yeah.
But real quick, why did you use a sum of parts approach to this?
I realized that if you just straight up use the normal commercial banking, if you just did the valuation for that, just the price book on that, it would come out to be way lower than what you needed it to be, because private equity, venture capital tends to be much more.
How you use that language there, what you need it to be. What do you mean by what you need it to be?
So it's in terms of riskiness, in terms of like, because for private equity and venture capital, they're also much more riskier. And like in one of my slideshows, one of them was like, could you go back to one slideshow? One more. So here you see like some of like the price to the PE ratio here. Some of these are like huge. So I don't think it does it justice if you don't account for them. Especially how like they do generate 24% of the revenue for SVB. So I realized that this must be done, and just because there's a
the business models are very different, I think, with the commercial and residential banking, and with their private equity groups.
I will say one more thing. It's just what was it? Right. What was it? Oh crap! I lost my train of thought.
It's all right. You'll come back.
I lost my train of thought.
Bento, I'm gonna pitch in here, which I don't usually do. So some of these kids might actually be surprised, but with this, I'm going to defend their sum of the parts approach on this, because I think it's the only way to tackle an entity like this. So I fully support what you did. We can quibble about whether you should have used the average or the median or a whole bunch of things like that, but I strongly prefer what you guys did in terms of valuation. I support it. The other thing I might suggest is if you derive your own target and the stock's trading below that target, but there's a consensus estimate out there, maybe your soft buy becomes less soft buy if you use the consensus as opposed to your
buy.
Yeah.
Yeah, and
I don't have a problem with the approach at all. I just kind of want you to be able to defend it in the sense of other more traditional ways to value something,
So to add on to that, I'm sorry, I hear you, Chandler. I heard your voice, but to add on to that, because this company does not give out dividends, so I couldn't perform a DDM model for this one. And then for banks in general, the DCF model is it requires essentially like the enterprise value as well to be factored into for outstanding shares. And this is, for banks, it's very difficult to kind of see it because it's their debt is viewed differently kind of thing. Yeah. So it's very difficult in that sense.
I'll take one more comment from Chandler. I think he wants to chime in, and then we'll go to our last speaker.
Hey, Denny, this is Chandler Thurman. If you go up one slide to your bank comps, I think another thing that can be mentioned here is just the above average loan growth that Silicon Valley has seen. And really the only comp to that's posted over 20% loan growth consistently over the past couple of years is First Republic. If you look at that price to book, you can see that it also trades to a pretty wide premium to its peers. And so I think you could comp your price to book into some of the parts valuation and increase that by comparing it to other banks that have that mid-teens to high 20s loan growth compared to these larger commercial banks that are seeing little to none or negative loan growth over 2020. and also their guidance out into 2021, and raise that price to book median or average in your some of the parts valuation to get you closer and a better comparison, but also get you closer to those analyst price targets.
I understand you. So the other thing about this, whenever I was trying to make this chart here, was that these are all companies from the KBW large cap banks. So that itself is like a regional bank sector index kind of thing. So I picked up banks from that index particularly, but I didn't exactly just take in, this is a point of reflection. I didn't actually go back and look at like all of these banks and check their like their actual company classification to make sure they're like either 90% or 100% like commercial banking. So that I could have improved on that. Yes, sir.
No, I understand your comp group, and it's a good comp group. I'm just thinking if you take an equity screen of banks that have posted, mid-teens over 20% loan growth over the past 8 to 10 quarters, you could get a better price to book as far as how the market is attributing value to that above average loan growth, and then you can see it reflected in the price to book multiple. This thing trades anywhere from 60% to 80% premium to its peers just based on that growth.
Okay, I got you. Okay.
All right, thank you. Great comments. This is a great presentation, Denny. We're now going to transition to our last group, which is brand new analysts, and they're going to give us a sector update in the all-important healthcare sector. So with that being said, Annabelle and Hershey, take us away.
Hi, everyone. Like Dr. H said, we are going to be doing a healthcare sector update. My name is Annabelle Myers, and I am a lead analyst for the Smile Fund.
My name is Hershey Patel, and I'm a junior analyst. First, we wanted to give a brief overview of the healthcare sector's performance since the beginning of 2020. Healthcare stocks as a whole were relatively resilient in the second quarter of 2020 compared to the overall market due to many uncertainties surrounding COVID-19, but lost background in the third quarter as technology, communications, and other companies benefiting from COVID trends pushed the S&P higher. Starting in the fourth quarter of 2020, investors began pricing in hopes of an economic reopening, and sectors like energy and industrial began to rebound. The value rotation has continued, and year-to-date as of March 31st, healthcare underperformed the S&P 500 by 2.53 percentage points.
Moving to our subsectors, some areas within healthcare have performed well, while others have significantly lagged. The graph shows the entire healthcare sector's performance in gray, with subsector performance color-coded. The consistent outperformer over the course of 2020 and quarter one of 2021 was equipment and supply manufacturers like companies Medtronic and Abbott Laboratories, with a 22.51% return. Care providers and health services, which include companies like United Health Group, also performed well with a 24.83% return over the period. Healthcare technology underperformed and returned only 0.23% over the period as the result of a larger correction in technology stock in February's tech reg and reduced technology investment from healthcare companies in 2020. With this in mind, here are our current holdings and approved list for the healthcare sector. We have a variety of insurance providers, service providers, biotechnology, pharmaceuticals, and diagnostic and research companies. Although our analysts regularly monitor these companies and find target prices for the companies we enter, COVID has been especially impactful for the healthcare sector, which makes forming a target price even more difficult. For this slide, we have used Bloomberg's average analyst target prices and average analyst recommendations in order to give a sense of return potential and current analyst sentiment. We currently hold Zoetis, Medtronic, Thermo Fisher, Viva, and United Health Group. These companies are focused in the healthcare equipment, services, and technology industries, which we view favorably relative to big pharmaceutical companies. While many companies of the approved list receive buy recommendations from analysts, we believe our selections offer greater growth with potential with a better risk profile than some high-risk companies like Novavax.
Let's take a closer look at our recent trades made in healthcare. We exited Johnson & Johnson and AbbVie as we believe our selections trades offered better upside potential. Johnson & Johnson received emergency authorization from the FDA for the use and distribution of its COVID-19 vaccine, but we believe the company's long-term growth will be unaffected by this. AbbVie lost exclusively of its Humira drug, which has blurred the outlook for the company significantly because it accounts for approximately 60% of total company sales. While new drugs are in the pipeline, it is not certain what the impact of the Humira loss will be in the long term. We entered Thermo Fisher and Viva as we believe they have greater growth potential in long term. Thermo Fisher saw 51% organic revenue growth in 2020, and we will see improvements in its analytical instruments segments as universities and research centers resume investments that were paused due to COVID. Additionally, its biopharma segments will see long-term growth from the opportunities in living medicines, gene therapies, and more. Viva, a cloud-based healthcare technology company, helps biotech and pharmaceutical companies manage their customer relations in their sales and marketing. It has seen 20% annualized revenue growth over the past 5 years and has an impressive 100% revenue retention rate, which supports its ability to grow its customer base long-term. Additionally, the company serves as a rather niche market, which has allowed it to establish a foothold in a growing industry apart from competition. Briefly, we want to mention a few areas in healthcare which we believe are attractive and then give few company recommendations. First, we believe we will see an increase in diagnostic and testing as a result of COVID-19. People may be more likely to seek out diagnostic testing in order to screen for health issues, and doctors may be more likely to recommend testing as science improves and test proves to be beneficial for early identification for certain health conditions. Second, we believe genetic sequencing and epigenetics will see exponential growth over the coming years. Genetic sequencing allows for better identification and treatment for certain diseases. This is also crucial for some disease like cancer, where early identification and individualized treatment can greatly improve patient outcomes. Epigenetics is an exciting field of study, and some companies are using it to better understand disease components and learn how to alter DNA expression to treat medical conditions without altering DNA composition. Finally, we believe there's an opportunity in home health services as we think more people will desire in-home therapy and elderly care as opposed to care provided in a facility after COVID-19. Additionally, an aging population will increase the need for these services and will be a tailwind for the industry overall.
Based on these themes, here are 3 companies we have identified for further research. LabCorp was recently named one of the most innovative diagnostic and research companies by the Fast Company magazine. Fast Company magazine recognizes companies that help reshape industries with their contributions with their innovation of products. LabCorp did assist with COVID-19 testing and are continuing to research ways to help the world get back to normal. However, they are one of the top 2 lab and diagnostic companies across America. They assist with helping doctors diagnose illnesses such as diabetes and high cholesterol. With the vaccine becoming widespread and America getting back to normal, more people will begin going back to the doctor's offices for testing to determine the reason for their symptoms and possibly diagnose various illnesses. Direct has been working on a drug to assist with epigenetics, which has to do with gene expression. They recently had a peer-reviewed article published with their research, which can assist with going forward with the next steps. The world could significantly benefit from this, and that it could help mitigate certain illnesses. And last but not least is Ensign Group. Ensign Group is a home healthcare company. They specialize in providing in-home therapy. The world is changing every day in the way we utilize healthcare. With this company, it falls in line with the changes in that more people will want to utilize having nurses or physical therapists or occupational therapists come to their home instead of going to their doctor due to the risk of deadly illnesses for elderly and immunocompromised individuals. And thank you, everybody. Are there any questions?
I thought your presentation was very good. And Hunter, this was, I know I missed the last one. I'll commend the entire team because I think this was one of the better ISMs that I've attended. So I think that the kids did an awesome job in terms of prep. Again, it's kind of something that I've said for years is, I think where they may be lacking is just the cohesion among the different sections, you know. So if we've got the vice president of risk management concerned about the variance, there should be some, you know, expectation among the other analysts to acknowledge that's a risk factor and think about some other ideas that would, you know, reflect in an environment wherein COVID doesn't go away or we don't achieve herd immunity, those types of factors. But I think just by and large, though, the depth of work was impressive on this one. And I think you all did a great job.
Thank you very much, Ray. We appreciate it. They definitely have donated a great deal of their time. I'd like to point out too that our students do not get paid to do this, and that most of, if not all of this work is pretty much pro bono. I think that it shows a dedication to their future craft, and I'd like to commend the students. I'd also like to thank every one of you for coming today. Our next ISM will be in September, and we hope that it'll be face-to-face. And so hopefully the variance will prove to not be a big deal, and our investments will continue to prosper. And we thank you, and I appreciate it. And I hope that you see that the Smile Fund is paying both literal and figurative dividends for our for the UC Foundation, for UTC, and for our students. Thank you all, and have a wonderful day.
Hunter,
yeah.
What are we, the NCAA? The NCAA is going to start paying its players. What are we going to? We're going to start paying students now. Is that what I just heard?
Well, they get.
Hey, I may need to step in here and cut this conversation short.
Yeah, well,
we're being recorded, Minto.
Knowledge is its own reward, right? So,
do I get back pay?
So well, we will take a small percentage of y'all's future paychecks if we can get you all successful career paths going. So thank you all for coming today. We really did appreciate this extremely high participation and attendance rate. And I think you all got a little bit of an insight into what we do here at the Smile Fund and why it's so special. Have a wonderful day.